On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and joining me today is Tony Minopoli. Just like the name of the game, it's fantastic, and he is the founding partner of Innovative Asset Advisors Group. Tony, welcome to the program. We got a ton to get to today, but I want to start talking about your firm. Can you explain maybe to the audience? Maybe we have some members out there that are not familiar with
Sure.
Innovative Asset Advisors. Maybe you could tell them a little bit about it.
Excellent. Thanks, Todd. Thanks for having me. Great to be with you. So, Innovative Asset Advisors Group became, to use the proper legal term, became effective early last July. So, one of my best friends on the planet, Charlie Smith, is the principal, founder, principal partner of the Innovative CPA Group. And he had been wanting to create a wealth management firm for many years. They have, I don't know, 12, 13,000 clients, something like that. So to use his word, he began dripping on me about 5 years ago. And at the tender age of 56, I decided to become an entrepreneur and left my previous job with as CIO of Knights of Columbus to help create this. So we're a full service wealth management firm with a heavy emphasis on not only financial planning, but alternative investments and really kind of thoughtful leading edge asset allocation.
That's great. And Charlie's a great guy, and your firm does so many great things, and you're working with high net worth clients. So I have to ask now, when you're speaking to those clients, what are their biggest concerns these days?
Well, there's a little event going on in the Middle East right now, so that's certainly got people's attention. In all candor, I think most people, what they're trying to figure out, many of our clients, their primary focus is retirement. And we've been working with them a lot, not only trying to help them prepare for it financially, but also to understand, what does retirement mean for them? And longevity is definitely playing a risk because, if you retire at 65, it's entirely possible you could have a 30-year retirement. So these are some of the big picture things, and as well as the current happenings in the market, as you would imagine.
So one of the big things that you do is tax preparation, tax construction, how to minimize tax liabilities. So what's the one biggest mistake that, say, high net worth clients do, or really any client for that matter, that they do when it comes to taxes and investing?
Well, one of the reasons we pulled together our firm is to seamlessly be able to help clients with tax issues and investment issues. And already there have been several occasions where Charlie and I have been on a call with a client and in real time be able to discuss a tax matter and how it plays in. And in so many cases, individual investors will compartmentalize their tax life from their investment life. And particularly as you're approaching retirement, they're just inextricably linked. So, for example, the decision to convert an IRA to a Roth, well, there's investment implications, but as you and I both know, there's serious tax implications. So to make that decision in a vacuum without having your tax professional with your investment professional is pretty foolhardy. And I would add something I read this morning. It's something like some major number, like 74% of investors with portfolios of over $2 million. Can't remember the source. If I can find it, I'll email it to you, but said they are using financial advisors. And I'm not just, trying to do the marketing thing, but look, the world is getting more complex. And to the extent that you can bring these professionals around you, we like to tell our clients that we're going to add value by more than our fee, every year. And just take this Roth decision, the decision to do it, how to do it, when to do it. The tax implication could be massive. So that's really something important to us in a way we try to work with our clients.
So it sounds like you're almost like a financial doctor where you're bringing in the specialists, you're walking them through what they need. But I would imagine what happens when matters get a little complex, too complex? Do you have to outsource that, or is that a service that you can provide in-house?
Yeah, well, the CPA piece, either we work with our sister company, Innovative CPA Group, or we'll work with the client's CPA. So there's no you don't have to use the whole of our service, you can use the pieces that you use. But we'll work with estate planning attorneys, things of that nature as it matters, as it makes matters to retirement things. And there are, I mean, estate planning rules change all the time. So making sure, we make sure with our clients that we're having them focus on those issues. Annually, we make sure we revisit their financial plan. Or we really insist all of our clients have a financial plan. I used to tell my institutional clients, don't tell me what your risk tolerance is. Your asset allocation tells me everything I need to know, right? It's explicit in how you're doing. And it's really the same in your financial plan. So you could say you're a conservative investor, but how you're structured says a lot more about what you're trying to do. And I think intentionality is really a big part of how we think about it. Let's be intentional on the plan. Let's be intentional on your asset program. Let's be intentional on the direction that we're trying to take your financial life.
And on those assets, on those investments, you like to bring up institutional quality, quote, institutional
Yeah.
quality investments. For investors new to the space, can you explain what you mean by this?
Yeah, it's been a wonderful past 5 years, Todd, because one of the things that's happening is that there's been a tremendous democratization of asset managers. There's a massively well-known large bank in New York that has run money for institutions for a long time, and they've brought down, their municipal bond strategy, for example, where advisors can use it for their clients at 12 basis points at a $100,000 minimum. So if you've got a taxable account, am I going to be able to hire the same experts, but to be able to pull these experts together in a certain sense? Yes, I trade stocks and bonds for my clients, but sometimes it's sort of back to the future. I'm back to my early days when I was an advisor with Evaluation Associates, working with large institutional clients like Colgate and Bristol Myers and Con Edison and the National Football League, and really finding the very best providers in all sorts of places to pull them together to give clients an amazingly well-managed portfolio. And then fast forward to some of the new products, buffered ETFs, auto callables. I mean, they're interesting strategies, but they really do and can have a place. And I think having a broad view, having a 35-year investment career, having been around sophisticated products, those are the things that we're trying to do for our clients.
Well, definitely interesting. And one of the hottest areas right now is private credit. So we have to talk
Yeah.
about this area. What is driving the interest in private credit these days?
Well, the interest in private credit historically, this piece hasn't changed. It's been extra yield, and for many years, you've been able to purchase, be in a private credit fund, have yield in excess of the high yield bond market. However, having much better asset protection. So in general, these are first lien. So you have a serious amount of collateral backing your loan. So you're in a first lien position. You are generally in floating rate. So in this rising rate environment that we've had, your coupons have kept up because every quarter these loans are resetting, and you're working with very high quality firms. What's going on now is that AI, we're all still trying to figure out what AI means. And I think what we're seeing is that people are concerned the high quality loans that may have been made to software companies, are those software companies going to be there? Is the nature of the beast going to change because of AI? So I think there's a headline right now that private credit is problematic. But we would tell you, I think, yeah, you have to go next level, as you do with so many times in investing, to really dig down and understand. There are several of the private credit strategies that we're working with that have almost no allocations to the software area or a very low allocation. So I think, as anything, knowing what your fund is investing in is going to be paramount to understanding the amount of risk that you're taking. But we still think there's a tremendous opportunity.
And that is always the case, right? You want to know what you're investing in. So what are the risks right now? Or let me rephrase the question. Would you recommend or suggest to a client that maybe they should stay away from the AI induced type of private credit investment?
Well, I think if you're dealing with a fund that has been software heavy, that their focus has been on lending into software, this is going to be a transitionary period for them. It's happened at other points in the U.S. economy. If you go all the way back right to the Industrial Revolution, right, the world changed when farms were able to produce more food than they just feed their family, and the Industrial Revolution happened. Massive changes in the economy. It happened when the internet first hit, and now with AI. I mean, we're making more and more use of AI here all the time. I think it's going to change the nature, the nature of the beast. So, but to your specific question, if you have a credit fund that has been heavily lending into the software arena, how are they pivoting? And in many cases, Todd, these loans are 2 to 4 years in length. So if they've got good credit quality, the software companies they're investing in are making payments, and they're going to see those notes mature, they'll be able to reinvent themselves along with the market. So we're also looking at patience. And like any other time with Wall Street, there are funds now being constructed to go out and buy some of these loans at discounted levels. So never discount the creativity of our friends on Wall Street.
That's for sure. Let's talk about access and strategy then. So typically, years ago, at least during my days at Merrill Lynch, I remember these types of investments, alternative type of investments with private credit, were only available to really ultra institutional high end types of firms that were really used for really kings
Yeah.
powers that be. But now there's more access. So how is it that Innovative is finding or permitting their investors? What types of investments are you providing to your clients?
Well, we're going across the board. So I'm going to date myself a little bit. I've been investing in alternative investments since the early 1990s. So I tongue in cheek joked in something I wrote about 3 or 4 months ago. You can't claim expertise in this asset sector if you just got into it last Tuesday, right? There's a different level of due diligence because liquidity, even the semi-liquid, we change the words all the time, right? Semi-liquid is kind of a thing right now. The reality of it is these investments are by nature private and illiquid assets. So you should think of them in those terms. We're looking at things in credit. We're looking at things in infrastructure and real estate, and also in private equity and private equity secondaries. And let me talk to you about why we think of them in those terms. If you think about, we've been talking about private equity, private credit, Todd. Part of what's there, right? The focus of that investment is income, right? It's most of the return is going to come from the income generation of those investments. When you think about infrastructure and real estate, part of the income, the return is coming from income, right? Rental income, royalties, things like that, but some of it's capital gain. And then when you get to private equity and private equity secondaries, that's much more of a capital gain, kind of a growth mindset. So you can really mix and match depending on the clients. And we've been building custom suits, if you will, for a number of our clients, predicated. I have a client I'm working with, ultra high net worth individual, has a lot of income, but wanted to be more in private equity secondaries and infrastructure and real estate. So that's what his portfolio looks like. I have another client that I'm working on that's closer to retirement. That's like, hey, no, I really need more income. How do we structure that? So again, with this democratization, platforms like Schwab, like iCapital are and the providers, I mean, the brand names, the Ares, the Blackstones, the Apollos, Adams Street, Audax, they're bringing their minimums down to where the average investor now can meet these minimum accounts and be able to actually build a diversified portfolio. So I think it's a really exciting time.
Custom suits. That's the line of the day. I love that. So let me ask you, let's turn the page to the macro side. I really want to get your thoughts on what's happening today. You have, obviously, there's inflation concerns. We saw wholesale inflation up almost 3.5% year over year. You have the war going on. There's uncertainty with the Fed. How should investors position their portfolios today?
Yeah, there are some people that are traders, right? They want to trade the market and, where's gold, where's oil, where are equities. But when we think about the macro environment that we're in, one of the main focuses we had coming into this year is that inflation was still not tamed. You were still seeing it in various pockets of the market. And then we couple that with what's been going on in the employment market. Um, Employment at the headline looks great. Numbers have been good, new jobs, but then you go next level. And when you begin peeling away at what's been going on in the employment market, so much of the growth has been in healthcare. Now, I'm going to speak in economic terms, and let me say I admire immensely home healthcare workers and home healthcare aides and the tremendous work that they do taking care of our seniors. But in a pure sort of green eye shade sort of way, those are not the highest paying jobs. And if that's where the market is growing new jobs, we have to think about really the US economy. We're a consumer economy. 70% of the US economy is driven by consumer spending. And if the jobs that are being created are at the lower end of the pay structure, well, what does that mean for aggregate spending and aggregate demand? And how does that translate into a robust and growing economy? So I think the Fed has been, and I think will continue to be data dependent. They were not seeing inflation coming down, and they were also seeing some chinks in the armor, if you will, with respect to employment. What they're trying to avoid in a great case is the worst of all possible environments, stagflation. Stagnant growth, high inflation. Horrible. Um, so we're in a little bit of the potentiality of that environment, and then you throw the conflict in the Middle East right now. Oil, whether or not we're driving more efficient cars and homes are more efficient, the reality is energy touches every facet of consumers' lives. So does oil settle in at 100? Does it settle in at 150? Until the Strait of Hormuz opens, it's going to be hard for a meaningful downtick in energy prices. So we think on the intermediate side, inflation is going to be with us a little bit. I think that also is going to weigh heavily on stocks because, as you know, coming into this year, everyone was all eyes on the Fed. Is it 2 cuts? Is it 3 cuts? Is it more aggressive? It's hard for the Fed to do anything right now, given what's going on the other side of the world.
Yeah, I completely agree with you, Tony. You're absolutely right with that with those comments because there was this expectation that we were talking about multiple rate cuts, and now the narrative has completely shifted. There's actually an 11% chance, this is according to IBKR, an 11% chance of a rate hike when the Fed meets on April 28th and 29th. So that begs the question then, do you believe that we might actually see rate hikes later on this year?
If inflation begins to accelerate, there is a chance you're going to see the Fed increase because they have their dual mandate, right? Low inflation, high employment. That's what the Fed is all about. And there are times that they'll sort of tack one way or another depending on the environment. But I've always felt that they will sacrifice employment to keep inflation because let's go all the way back, right? You and I are old enough when you think about the Volcker era, right? I mean, I was still a pretty young guy, but Volcker jacked rates up. We know the prescription for knocking out inflation, right? You jack rates to the moon and suddenly there's no economic activity. But also remember what happened with employment. We had extremely high unemployment, but it was what needed to be done. I think the subsequent Feds after that, you pick your favorite Fed chair, I think they all saw that environment and said, we've got to keep inflation from getting to that point because of the damage that has to be wrought on the economy in order to bring back down inflation. And let's face it, you got real people involved that are losing jobs. So that's why I think yes, they have a dual mandate. I think they're going to lean a little bit more towards controlling inflation.
Yeah, it's very smart analysis, and I do agree with that. So, final question for you. With everything that's going on, what is one piece of advice that you would give to a client about preserving wealth in 2026?
I think patience, because people think about, right, risk is really two pieces, volatility and the risk of permanent loss. And if equities are trading down or bond rates yields have gone up, so the bond prices have come down, I'm asking clients to focus on being more patient. If you have a well-diversified portfolio, you believe in the long term of the economy, by being patient, don't convert volatility into permanent loss by selling at a time that an asset's distressed in price, but not necessarily distressed from an asset class. Equities will come back. Oil prices will come down. We will ultimately get inflation right. We just have to solve the geopolitical issues. And right now, I think geopolitical is in front of economic factors, and that's how we're working with our clients.
Yes, very, very good point. Well, we'll see. We'll see what happens. I know we're going to have you back later on, Tony, later on this year, probably in next quarter, to really talk further about this. Hopefully, the war will be over and we'll start to see a little bit more stability in the markets and the economy. But Tony, how can investors and individuals reach you?
So, Innovative Asset Advisors Group, just you can search us on your favorite browser and find us. We are a full service. We're growing, and we're looking both at advisors joining us, which has been exciting, and clients coming on. So we look forward to hearing from folks and continuing the discussion. And I look forward to getting back together with you, Todd, to talk through some of the crazy things that are going on in the world right now.
No doubt about that. Well, you definitely have a strong roster of employees there, and I know everyone would get a lot out of reaching out to you, so that's great. Tony, thank you so much for joining me. Can't wait to have you back, and I know we're going to talk further about this. So on behalf of Tony Minopoli, I am Todd Schoenberger. Thank you once again for joining us on The Money Path. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.